Yes, welcome. So in this session, I want us to look on this topic of income taxes. And as far as this topic is concerned, we're going to first of all define what is income tax. Then from there, we look on the recognition, measurement, and also presentation of two types of taxes. That is the current tax and also the deferred tax. But first of all, we need to define what is an income tax. And basically, this refers to the tax which is payable by companies to the tax authority in relation to the trading activities of a certain financial year. Because basically what we know is that a company is a legal entity, and therefore as such, a company is required by the tax laws to pay the tax to the government or to the tax authority. So that tax, therefore, which a company is supposed to pay in relation to the trading activities of a given financial year is what we refer to as the income tax. So therefore, income tax, we can say that this is the tax payable by a company to tax authority, to tax authority. Now, in this case, we're going to look on the recognition, measurement, and also presentation of two types of income taxes. So therefore, in this case, we have two types of income taxes. So the first one is called the current tax. And number two, we have the deferred tax. So we start with the first one, which is the current tax. So when talk about this tax here, that is the current tax, this refers to the actual amount of tax payable to the tax authority in relation to the trading activities of an entity in a certain financial year. So therefore, current tax is the actual tax to be paid. And this tax is always computed or is always determined based on the taxable profit of what? Of the company. So therefore, current tax, we can say that this is the actual tax, payable to the tax authority, in relation to trading activities of an entity in a certain financial year. So therefore, the current tax is the actual tax to be paid by an entity or basically by a company in relation to the trading activities of a given financial year. And therefore, on the other hand, we have said that it is based on the taxable profit. It is based on the taxable profit. So means that when the company is computing the actual amount of tax to be paid, the company has to compute that based on the taxable profit. And actually, taxable profit, this is the profit which is computed by the company using the existing tax laws. And therefore, to compute this taxable profit, a business entity takes into account the taxable incomes, and then the business or a company will have to less all the allowable expenses. And then the business will get the taxable profit and then subject that to the tax rate to determine the actual tax to be what? To be paid. So therefore, the current tax here, we can say that this one is equal to the taxable profit. Times what? Times the tax rate. So this particular current tax, which has then been determined based on this particular taxable profit, is always recognized as an expense in the income statement. So when the company is preparing the income statement, this particular current tax is supposed to be deducted from the profit before tax. So mean that essentially this is what is an expense to the company. But it's also important to note that this tax to be paid by a company in relation to a certain financial year, it can only be determined once the company has prepared the financial statement. So basically what that means is that whenever, for example, as an accountant, you are preparing financial statements at the end of the year, so the amount of tax which you account for in the income statement is not the actual tax to be paid, but rather it is a provision. So you just estimate the tax to be paid, and then you provide for it in the income statement, and then later on you'll have to determine the actual tax to be paid. And once the actual tax has been determined, then that may result to something called the over provision, or basically under what? A provision. So the over provision or under provision therefore arises because the provision which was created at the end of the year when the financial statements were prepared, that provision was either more or less than the actual tax to be paid. And therefore, here we can talk of the over stroke under provision, a provision of current tax. So number one, we of a provision of current tax, of a provision of current tax. This one arises because the provision which was created by a business entity when the financial statement were prepared at the end of the year, this provision was more than the actual tax to be paid. So therefore, of a provision, and this one arises. It arises when the provision created was more than the actual tax payable, than the actual tax payable, So how do we deal with this particular over provision of current tax in a certain financial year? So this particular over provision is supposed to be carried forward to the next financial year and is always deducted from the estimated tax liability of the following financial year. But it's also important for me to mention that anytime a company has over provision of current tax, this one in the trial balance will always be having a credit balance, because once you come across an exam you come across a question relating to this, whereby maybe the examiner has given you over provision or under provision in the trial balance, specifically the examiner will not specify whether that balance in the trial balance is over provision or under provision. Is upon you to know. So anytime you're given a current tax in the trial balance and you're told that that current tax is over provision or under provision, and that current tax is on the credit side, then always it is what? Over provision. So therefore, first of all, you can say that over provision, this one has a credit balance, in the trial balance, And also we have said that this over provision, we have said it is carried forward to the next financial year. And deducted from estimated tax liability of that financial year. So basically what that means is that if, for example, we are told that in the year 2023, there was over provision of 5 million for current tax, that over provision would be taken to the year 2024 and it will be deducted from the estimated tax liability of 2024. That is very, very important. Then on the other hand, under provision of current tax, this one arises whereby the provision which was created by the business entity in preparing the financial statement at the end of the year, that provision for current tax, was less than the actual tax. So therefore, under provision analysis, whereby the provision created when the financial statements were being prepared was less than the actual tax, and this particular other provision, on the other hand, in the trial balance, it always has a debit balance. This other provision always appear on the debit side of the trial balance. So how do we deal with this particular other provision of current tax? This other provision of current tax, we take it to the next financial year, and we do what? We deduct it, we add it to the estimated tax liability of the following financial year. So therefore, this is supposed to be added to what? To estimated tax liability, to estimated tax liability of the following financial year. Estimated tax liability of the following financial financial year. So therefore, as far as the current tax is concerned, those are some of the points which you need to know, that current tax is the actual tax to be paid by a business entity in relation to the trading activities of a certain financial year. This one is computed based on the taxable profit. So mean that to compute the current tax, we take the taxable profit, which you have said is a profit computed using the existing tax laws, times the tax rate. And then what you have said is that this particular current tax here, according to the International Accounting Standard number 12, it is supposed to be recognized as an expense in the income statement. But it is also important to note that if this tax will not have been paid at the end of the year, then it is recognized in the statement of financial position as a current liability. In case the company has paid an excess tax, at the end of the year, it is recognized as a current asset. But also, here what you have said is that this actual tax to be paid can only be determined once the financial statements have been prepared, meaning that whenever the financial statements are being prepared, the amount of tax which is recognized in the income statement is just a provision, is just an estimate of the tax to be paid. And therefore, you have said, as a result of that provision which will be created, then there may be over provision or other provision. You have to remember, we have said that over provision always will arise whereby the provision created was more than the actual tax. That over provision has a credit balance in the trial balance. You take it to the next financial year, to the following financial year, and you do what? You deduct it from the estimated tax liability for that year, and the provision arises whereby the provision created was less than the actual tax, and that over provision and the provision that is in the trial balance, it has a debit balance. It is taken to the next financial year and added, and what? Added to the estimated tax liability of the following financial year. So those are basically some of the important points to know as far as the current tax is concerned. So next, I want us to look on the other type of income tax, and that is the deferred tax. Deferred tax. So when talk about the deferred tax, as the name suggests, this is basically a tax which has been delayed, or in other terms, we say it is a tax which has been postponed, and it will be paid in the future, or it is a tax which will be recovered by the company in the future, because we have something called a deferred tax liability. This is a tax which will be paid by the company in the future. On the other hand, we have something called a deferred tax asset, which is a tax which the company is to recover in what? In the future. In other terms, it is a tax refund. The company will recover, or basically will be refunded by the tax authority in what? In the future. Now, deferred tax, this one, arises as a result of the difference between the accounting profit and taxable profit. Anytime these two profits are different, accounting profit and taxable profit, automatically that gives rise to something called the deferred tax. So therefore, we can say that this is a tax payable or recoverable by a business entity in the future. On the other hand, we have said it arises as a result of the difference as a result of the difference between accounting profit, between accounting profit and taxable profit. It arises as a result of the difference between accounting profit and taxable profit, accounting profit and taxable profit. So what is the accounting profit? Accounting profit, this is in other terms known as the profit before tax, and this is a profit which is computed by a business entity using their various accounting policies adopted by such a business entity, and also using various accounting concepts or principles which are supposed to be used by companies or by businesses in preparing their financial statement. So this is the profit which you prepare as an accountant, or which you compute as an accountant by taking all incomes of the company and deducting all the expenses. But on the other hand, we'll talk about the taxable profit. This is a profit which is computed based on the existing or using the existing tax laws. And actually, when computing the taxable profit, we only take into account the taxable profit of the company with less allowable expenses. So that profit which we get is known as the taxable profit. And therefore, we are saying deferred tax arises because these two profits are what? Different. And on the other hand, that difference between accounting profit and taxable profit broadly can be classified into two categories. So therefore, you can say that the difference between accounting profit and taxable profit can be broadly classified into two. Can be broadly classified into two. Number one, we have what we refer to as the permanent difference. A permanent difference. And number two, we have the timing difference. So therefore, the difference between accounting profit and the taxable profit, we are saying, can be broadly classified into timing and the permanent difference. So what do you mean by these two differences here? So let's start with the timing difference. And the timing difference is the difference between accounting profit and taxable profit, which arises as a result of taking into account various items of incomes and expenses in the computation of accounting profit and taxable profit, but in different accounting period. So therefore, we can say it arises as a result of taking into account certain items of incomes / expenses in computation of profit before tax. Remember, profit before tax is the same with the accounting profit, and the taxable profit, but in different accounting period. So it arises as a result of taking into account certain items of incomes or expenses in the computation of these two profits, but in different accounting period. For example, in this case, we can be told a business incurred a certain expense, and this expense was incurred in the year 2023, meaning that this expense was used in the computation of profit before tax or the accounting profit in the year 2023, but we are told this particular expense here will only be treated as allowable expense as a allowable expense, meaning that it will only be taken into account in the computation of taxable profit, maybe in the year 2025. You can see this particular expense, which was incurred in the year 2023, is used in the computation of accounting profit and taxable profit, but in different financial years. In computing the accounting profit, or that expense is taken into account in computing the accounting profit when it was incurred in the year 2023, but it will only be treated as a allowable expense, or it will be taken into account in computation of taxable profit in which year? In the year 2025. So that will make the accounting profit and taxable profit to be different in the year 2023, and that difference then will reverse in the year 2025. And therefore, this particular difference here is the one which gives rise to the deferred tax. So timing difference gives rise to deferred tax. Gives rise to deferred tax. Gives rise to deferred tax. So then let's define what is the permanent difference. Number 2, we have permanent difference. Permanent difference. So permanent difference, on the other hand, is also the difference between accounting profit and taxable profit, which arises as a result of taking into account certain items of incomes and expenses in computation of accounting profit, but those items of incomes or expenses are not taken into account in the computation of taxable profit. So therefore, you can say it arises as a result of taking into account certain items of incomes stroke expenses only in computation of accounting profit. So we have those particular items of incomes or expenses which are only taken into account in the computation of accounting profit, meaning that these particular items of incomes or expenses are not taken into account in the computation of the taxable profit. And good examples of such items of expenses include depreciation. We also have fines and penalties, etc. Simply because what we know is that fines, penalties, depreciation, and so on, these are disallowable expenses. When computing the taxable profit, whenever you are computing the taxable profit of a company, we don't take into account these particular expenses because according to the taxman, they are disallowable expenses. But in computation of accounting profit, then all these are expenses. We take them into account. So that difference, therefore, is known as the permanent difference. And actually, we say that this particular difference, the permanent difference, it only occurs in a certain financial year, and therefore, this difference, unlike the timing difference, does not give rise to deferred tax. So therefore, you can say this difference do not give rise to deferred tax. Do not give rise to the deferred. Do not give rise to deferred tax. So therefore, it is important to note that out of these two differences, the timing difference and the timing difference and permanent difference, the difference which gives rise to deferred tax is the timing difference, because we are saying the permanent difference, these one do not give rise to deferred tax, and therefore, in case there is a permanent difference, then this one will be totally ignored for the purpose of computing the deferred tax. Before we look on how we compute the deferred tax, there are some few terms we need to define here, and which basically we're going to come across in looking on how we compute the deferred tax. The first term is something called the carrying amount, abbreviated as CA. So carrying amount here, this is the value of an asset or liability in the statement of financial position. That particular value at which an item of asset or liability is recorded in the statement of financial position, it is the carrying amount. So we can say it is the value of asset stroke liability in the statement of financial position. Value at which an asset or liability will be recorded in the statement of financial position. The other term we also need to define here is the tax base, that is TB. And tax base, this on the other hand, is value of asset stroke liability for tax purpose. For tax purpose. So it is a value of an asset or liability for tax purpose. And actually, when determining the tax base of an asset or liability, what we do is that the tax base of an asset or liability, actually we say it is actually the amount, the value, which is the value of an asset or liability, which is used in computing the amount which will be taxed, or maybe the amount which will be allowable. A good example is if, for instance, we have an asset which qualifies for capital allowance, then the value of such an asset for tax purpose is the written down value, because if the company sells such an asset, in determining the amount which will be taxed or allowable, we take what? We take the sales proceeds, the value at which the asset was sold at, and then in this case, we less the written down value. So therefore, this is the value of an asset, or the value considered for such an asset in determining the amount to be taxed or in determining the amount to be allowable. So the other term we also need to define here is the temporary difference. Temporary difference, abbreviated as TD. And temporary difference is the difference between these two values. It is the difference between, between carrying amount and tax base of an asset or liability. The difference between carrying amount of an asset or what? Liability. Now, in this case, we have two types of temporary differences. So we can say a temporary difference can be, temporary difference abbreviated as TD, can either be, number one, taxable temporary difference, abbreviated as TTD, and number two, the deductible temporary difference, abbreviated as DTD. So what do you mean by these two types of temporary differences? So let's start with the first one, which is the TTD, taxable temporary difference. A taxable temporary difference is a temporary difference which gives rise to amount which will be taxed in the future once the company sells an asset, or once the company decides to do what? To settle a liability. So therefore, you can say that this is the amount, or basically we can say that this temporary difference give rise to amount taxable in the future. It gives rise to amount which are taxable in the future whenever the company sell an asset or settle a liability. And actually, a temporary difference is said to be taxable whereby the carrying amount of asset or liability is more than tax base. Because here we are saying that the temporary difference, this is the difference between carrying amount and tax base. So mean that if you compute the temporary difference and you get a positive figure, then that is a taxable temporary difference. So therefore, a taxable temporary difference arises whereby the carrying amount of an asset or liability is more than a tax base, So then from there we have deductible temporary difference. And this one gives rise to amount which will be allowable in the future whenever the company sell an asset or settle a liability. So we can say this temporary difference give rise to amount allowable in the future when the company sell an asset or settle a liability. And actually, a temporary difference is said to be deductible, whereby the carrying amount of an asset or liability is less than the tax base. So therefore, it is important to note here that we have those two types of temporary differences, the taxable temporary difference and the deductible temporary difference. So that was the other term number 3. Let's define the term number 4, and that is the deferred tax liability. Number 4, deferred tax liability, so abbreviated as DTL. And a deferred tax liability, this is a tax to be payable by the company in the future in relation to taxable temporary difference. So this is tax payable in the future as a result of taxable temporary difference. Remember, in this case, we have said a taxable temporary difference give rise to amount which will be taxed in the future. And therefore, to compute the deferred tax liability, we take the taxable temporary difference and then we multiply that with the tax rate. That's how we compute the deferred tax liability. The other term, number 5, is deferred tax asset, abbreviated as DTA. And a deferred tax asset, on the other hand, is a tax recoverable by the company from the tax authority in the future. So this is a tax recoverable by a company in the future as a result of deductible temporary difference and unused tax losses. It is the tax which the company will recover from the tax authority in the future. And therefore, to compute the deferred tax asset, we take the deductible temporary difference times the tax times the tax rate. So that's how we determine the amount of deferred tax asset. That's how we determine the amount of deferred tax asset. So therefore, those are some of the terms which you must be in a position to define. You may be required to define some of those particular questions in an exam setup, but also it is important for you to know them because anytime you're required to compute the deferred tax, that particular knowledge is important. Then, whenever the company or a business entity is determining the amount of deferred tax, there are two approaches which can be used. The first one is called a balance sheet approach, and then we have another one which is called the income statement approach. And therefore, here we can discuss those two approaches of determining deferred tax. Approaches of determining the deferred tax. So in this case, we can say there are two approaches. There are two approaches, namely, number one, we have income statement approach. Income statement approach. And number two, we have the statement of financial position stroke balance sheet approach, stroke balance sheet approach. So let's start with the first one here, income statement approach. So under this particular approach here, we compute the deferred tax, or the deferred tax is computed using the timing difference. Which essentially we said is the difference between accounting profit and taxable profit. So therefore, you can say under this particular approach, deferred tax is computed using timing difference. Using timing difference, which we said is the difference between accounting profit and taxable profit. And one of the or a good example of items which cause this difference is the difference between capital allowance or wear and tear and depreciation of the same asset. So if the capital allowance of a certain asset in a certain financial year is different from depreciation of the same asset in that year, that will make the accounting profit to be different from the taxable profit. Because when computing the taxable profit, as far as such an asset is concerned, we use capital allowance. But when computing the accounting profit, we use depreciation as what? As an expense. So if these two figures are different, then that difference is known as the timing what? Difference. But it's also important to note that this method is not recommended for use by International Accounting Standard number 12. So therefore, you can say IAS 12 does not recommend or do not recommend use of this approach. This approach is not the one which is recommended to be used by entities whenever companies are computing the deferred what? Tax. So the other approach, number two, is a statement of financial position or the balance sheet approach. So under this particular approach here, deferred tax is computed using the temporary difference. Temporary difference, in our case, we know that this is the difference between carrying amount and tax base of various items of asset and liability. So we can say under this approach, deferred tax is computed using temporary difference. Temporary difference or the temporary differences. And actually, we know temporary difference is the difference between the accounting profit and taxable profit. Is the difference between accounting profit and taxable profit. And actually, we can say this is the recommended approach. The recommended approach of computing deferred tax. Of computing deferred tax. So International Accounting Standard number 12 recommend that the deferred tax should be computed using this particular approach. The balance sheet or the statement of financial position approach. So therefore, those are the two methods which may be used in computing the deferred tax. What we refer as the income statement approach, whereby we have said we compute the deferred tax using the timing difference, and the balance sheet or the statement of financial position approach, whereby we compute the deferred tax using the temporary difference. And once we the deferred tax has been computed, or basically once we have used this particular approach here, we usually compute the deferred tax asset or the deferred tax liability at the end of the year. But it's also important to note that an entity should also be able to determine the amount of deferred tax to be charged in the income statement. So the amount of deferred tax to be charged in the income statement is usually computed by preparing an account which is called the deferred tax account. The deferred tax account. So this one is prepared to determine how much amount of deferred tax will be charged in the income statement. So in preparing this particular account, mostly you'll be given the deferred tax liability at the start of the year, and that one we record it on the credit side, being a deferred tax liability. A deferred tax liability. But in case you are given a deferred tax asset at the start of the year, we record it on this side. And then at the end of the year, you have now to use this particular approach. You compute the temporary difference, which will either be a taxable temporary difference or a deductible temporary difference. And then you compute the amount of deferred tax liability or the deferred tax asset at the end of the year. And in case you get a deferred tax liability at the end of the year, we record it on this side. So a deferred tax liability at the end of the year is recorded on that side, whereas a deferred tax asset at the end of the year is recorded on that side. There is something also which we record here. In case the company revalued either of these two assets, in case the company revalued either the property, plant and equipment or financial assets at fair value through other comprehensive income, and that resulted to a revaluation gain, then we compute something called the deferred tax expense. A deferred tax expense, which is equal to the revaluation gain times the tax rate. In case these two items of asset were revalued, there was a revaluation loss, we compute something called the deferred tax income equally by taking the revaluation loss times the tax rate. So any deferred tax expense on revaluation gain will be debited here. So deferred tax expense on revaluation gain of either PP or financial asset at fair value through profit and loss, and a deferred tax income on revaluation loss, we debit it here. And then what we do, we balance this account. Any balancing figure on this side will be taken to the income statement, and this is a deferred. This is a deferred tax expense, a balancing figure on that side, and a balancing figure on this side still is taken to the income statement. It is a deferred tax income. It is a deferred tax income. So that's basically how we compute the amount of deferred tax, which will be recognized in the income statement as a deferred tax income or a deferred tax expense. So therefore, that's basically what you need to know as far as the computation of deferred tax is concerned. So we stop at that point for now. See you in the next session as we look on more illustrations regarding how to compute the amount of deferred tax. So see you in the next session.